The New Jersey Bank Marketing Association presents Forecast 2010, a series of conversations with New Jersey's bank leaders about their outlook for the coming year. I'm your host, Steve Lubetkin. In this segment, Ray Hallock, President and CEO of Columbia Bank, with his outlook for the year 2010. Now let's go to the lectern for opening remarks from Dennis KANE of Amboy Bank.
This is by far the largest meeting we've ever had. We're delighted that everyone's here today. I have a few announcements before we start the program. First, I would like to thank the sponsors. The sponsors really allow us to bring the meetings to everyone at a very reasonable cost. We're pretty much just a committee, and our only objective is to bring educational programs, bank marketing programs to New Jersey, and that's why we try and keep our costs as low as possible so as many people as possible can attend. Steve Lubetkin, who you see is setting up a podcast, and you can see Steve, he's standing up on the stool. Steve's been doing this since March of 2005, and we have a website, njbankmarketing.com, and all of the podcasts we have since that time, the meetings are on podcasts. So if you visit the website, you'd like to see some of the other meetings, and or if you'd like to hear today's again, please visit the website. Steve has done this out of the generosity of his heart, and we are looking for people to sponsor Steve in the future, and if not, Steve also does this, and he can handle marketing for you or your marketing programs. So if you're interested in learning how to do podcasts or using Steve, he'd be more than happy to speak to you, right, Steve? This is our 21st annual meeting, and we've been doing this since 1988. And I went back to the old file, and I was trying to see what it looked like in 1988. And some of the things I noticed was that in 1988, George Tabor had just started NJ Biz magazine. That's the year they started. Dave Block's advertising agency was only 19 years old. Jerry Lynn, who you met when you came in this morning, would start a 21-year run as a BMA treasurer and meeting master. He's done such a good job, we just won't let him stop. We also had very many banks attending our first meeting back in 1988, and I looked at some of them, and they were Midlantic, Summit, UJB, First National State Bank, Fidelity Union, Howard Savings Bank, City Federal, Carteret Savings, to name a few, back in '88. A 12-month CD was paying 8%. Prime was at 10%. The CRA Act was 10 years old. And BSA meant the Boy Scouts of America. I guess we didn't know what BSA was. And I was 21 years younger and never dreamed that my son Damien would also someday be a bank marketing director. And Damien's here again today. We thought we knew where we were headed, but little did we know. Every year when we have this forecast meeting, we have wonderful experts come up and talk and said, this is where we've been, this is where we're heading, and it's fascinating to look back. Today we're honored to have industry experts, and I think the audience today is really an indication of how strong our speakers are today. They will give us a quick look at the recent past and try and look into their crystal balls and tell us where we're going in the future. So today should just be a great meeting. What I'd like to do is turn the meeting over to Jane Gore, who's our program chair for this meeting, whether she likes to or not. She gets named every year over and over again. So Jane will introduce the speakers. Jane?
I'm told by Dennis this morning that we're going to keep doing this until we get it right. After 21 years, you'd think that we would have had some of it right. I'm going to introduce first this morning Raymond Hallock. He was appointed President and Chief Executive Officer of Columbia Bank on January 1st, 2002. He is well known in the banking world and the business and community affairs. Raymond actively serves on many local charitable causes. He is the past president of the New York, New Jersey chapter of Financial Managers Society and past chairman of the North Jersey Institute of Financial Education. Understanding the role of community bank, he encourages all bank employees to give something back to the communities that they so proudly serve. Prior to joining Columbia, Mr. Hallock was a certified public accountant with KPMG Pete Marwick for more than 13 years. I bet they changed their names a couple times. And he earned his Bachelor of Science degree in accounting from St. Peter's College. He attended the Graduate School of Savings and Loans at Indiana University and earned a degree of distinction from the Institute of Financial Education. He's a longtime resident of Hawthorne, New Jersey, and in addition to being a superb banker, he's a great golfer. Please welcome Raymond Hallock.
I don't know about the great golfer comment. Jay Ford, who is usually my golf partner in many ventures, can attest to the fact that my game, as aging with process, has certainly been affected. What I'm going to try to do today is maybe give you a little flavor of what's going on in Washington, D.C., and what perhaps you may be able to do about that in the process. Because we all look around ourselves and see what's happening in our industry, and looking at the economy, especially here in New Jersey, worried about foreclosures, worried about credit risk, worried about lending activities. Certainly, probably on the horizon, we should be worried about interest rate risk when interest rates take off. So we had a lot of risks that we have to worry about, but I'm here to tell you today the one risk that you have to be focused on, probably is the biggest risk right now, is Washington. The risk is not only to our operations, it's to our basic structure as a banking industry. So with that, see if I can work this correctly. A big word today has been change. We've listened to that in the certainly in the political campaign that we just completed. And I always like to try to get a reference to what change is, because change certainly is a key down in Washington and a key to what's going on in the banking legislation. And as that noted, and you have to get a point of reference when I'm talking about change. And as that noted philosopher George Carlin once said, George said one time that trying to get an idea of what something cost, he had to relate it to what a six-pack was. So if you had a cost, that cost X number of six-packs, he understood the effect on his wallet. Let me just tell you two little stories about change. I'm a big sports addict, obviously. I'm a Yankee fan too, so we had some good change this year, the Yankees winning the pennant in the World Series. But change in a baseball game takes place, and a manager has to make certain decisions. And one of those decisions is, well, I got to change pitchers, or do I not change pitchers? And that can either lead to a good result or a bad result. Certainly when that manager goes out there to make the change in the pitcher, he doesn't know what the new person coming in is going to do. He's got all the statistical information. You see them go to their books and they look at lefty versus lefty, righty versus righty, the setup man, all specialists today. Well, let me tell you a little story about change, two stories about change and pitchers. Jeff Torberg, anybody heard who Jeff Torberg was? He was a catcher and a manager. He managed the Chicago White Sox for 3 years. In the early 90s, on one nice summer day in Comiskey Park, Jeff had on the mound Jim McDowell, excuse me. And McDowell was a 17-game winner that year, so he was his ace of his staff. And McDowell was not having a good game that day. And Torberg went to the mound to relieve McDowell of the ball and make a change. Now, he didn't know what the results were going to be, but as he walked to the mound, part of the process is the manager puts the ball out, puts his hand out, and expects that the pitcher will hand in the ball. Sometimes he'll walk out there and he's still undecided about the change, and he'll ask the catcher, what does he have? As he walked out this day, he looked at McDowell and he put his hand out for the ball, and McDowell would not give him the ball. And McDowell said, "Coach, I still have it. I'm not tired." To which Torberg said, "You may not be tired, but your outfielders are." So McDowell left the game. Another one that's closer to home, as I mentioned in the biography, I was a graduate of St. Peter's College, and we used to have a baseball coach at St. Peter's called Jerry Malloy, very noted Toastmaster, also coached at one time 3 high school basketball teams in 1 year, one of them being St. Pat's for Elizabeth. And if you follow high school basketball, certainly St. Pat's is still one of the top-ranked teams, not only in New Jersey, but the country this year. Well, Jerry had a habit of not knowing all his players' names. He gave them nicknames, and no one knew why that nickname stuck. And there's one pitcher who had in the team at St. Peter's College. His nickname was Hootie. Had no reference to the guy's name. As he walked to the mound this day to replace Hootie, he had made the decision. He asked Hootie for the ball, and Hootie said, "Coach, I really don't want to come out. I have already gotten this guy out once before." To which Malloy said, "That may be true, but it was this inning, so we're making the change." So we're talking about change. Let's just take a look at some things that, you know, when we looked at the start of the presidential election in November, the presidential season, well, it probably is 4 years now or 3 years, but let's just look at November, a year before the presidential election. Some of the key issues that we thought were going to be in the presidential election: illegal immigration and Iraq. Now we look, November 2009, if you had to rate probably the big issues, is the economy, certainly healthcare, and cap and trade. And I don't put that necessarily in order, but I'm just trying to give a point of reference to change and where we've come. And what happens with change is, to me, uncertainty. Now let me go back to baseball again, being a Yankee fan. When you make the change in the Yankees and you bring Mariano and Rivera in, you don't have uncertainty. But everybody else is going to have uncertainty. So as we look forward in what's going on in Washington, I stress to you that uncertainty is the name of the game in Washington and where we're going to be. So what I want to attempt to do today is, I'm not going to go through all the legislation, but I want to show you how drastic some of the legislation has been, where it formulated, where it came into Congress, and how it's been changed, and what you may expect in Congress for next year, or even the end of this year, because the House Service Financial Committee is still working on the reorganization, restructure bill. So with that, let me just go through some of the items that as you know, the administration came out with a plan during the summer, and their plan basically said, and again, I'm only going to cover 2 parts of the plans that have come out, and that's the restructuring or the supervision of financial institutions, as well as the consumer protection situation. And those kind of things were the things that I think really affect us. You had the derivative program and some other things, but I don't think they affected the majority of the community banks anyway in the state of New Jersey. So we start off with the administration plan called for a national bank supervisor, which would eliminate, well, would put together OCC and OTS. That was the major structural change in their plan. That's the Obama plan to come out into the Treasury, the Geithner plan. The Federal Reserve, status quo, no change. FDIC, no change. Interesting enough, we probably have some thrifts in the room today. I am a thrift. My charter was going to be eliminated under the Obama plan. Mutuals, not even mentioned. I'm a mutual institution. So obviously, the Obama plan did not sit well with Columbia Bank. The House bill, and by the way, one of the final pieces in the House bill was approved yesterday. House bill, Barney Frank has done a pretty interesting job of breaking the bill up into various pieces, and he's done a very effective job. I'm not saying that I agree with what he's done, but a very effective job in monitoring the process through the House Financial Services Committee. In that bill, OTS is gone. It merges with OCC. I am an OTS-regulated institution. So is the largest bank in New Jersey. Hudson City is an OTS-regulated institution. Jay Ford, I think, Jay, you're an OTS-regulated institution. I hate to see it go, but quite frankly, when you were responsible for IndyMac and WAMU, and you may have an answer to Countrywide, because Countrywide's put at their doorstep, but quite frankly, Countrywide was probably about only in the jurisdiction of the OTS for about 7 or 8 months before it had its problems. But still, OTS has been under the microscope for a long time. Many people in Congress have wanted to get rid of it. This certainly is one of the ways of getting rid of it and structuring it. The House bill, when it came out, did take into consideration the thrift side of the balance sheet, the thrift side of the industry, and they made a separate division of thrift supervision under the combined OTS and OCC, and a deputy individual in charge of that thrift supervision area. Predominantly, most of the OTS regulators, I would imagine, would come over to that division. The thrift charter survives, mutuality, no change, it survives, and also mutual holding company survives with some help on the waiver of the dividend, which was a big key for those mutual holding companies. And we do have a number, at least 5 large mutual holding companies in the state of New Jersey with over $1 billion. So it was an important issue through the banking industry in New Jersey. Thrift assets are significant in relationship to the banks that are domiciled in the state of New Jersey. So the House bill changed those major items that come out of the Obama plan. The Senate bill, this is Senator Dodd. I was talking about Senator Dodd before to a couple of people, and we were actually fortunate in the banking industry that Senator Dodd decided to run for president, because he spent an entire year in the state of Iowa campaigning and got 1% of the vote. Senator Dodd, being away from the Senate Banking Committee, could not cause us problems. Right now, no legislation is a positive to the banking industry. Let me get to the Senate bill here. He just recently announced it, 1,100 pages. Dodd's bill eliminates all supervisors and puts them into one. FDIC has no supervision. The Federal Reserve has no supervision authority. OTS is eliminated. OCC is eliminated. And we now have the Financial Institutions Regulatory Administration, or FIREA. I guess you call it that. We also have FIREA already, but spelled in a different name with respect to internal control aspects. Mutuals, where you would go. No thrift charter under his plan. Where you would go if you were a mutual, you ought to be state chartered, not federal chartered. So that's a kind of the picture of the landscape, and if that is not significant, that it would affect your structure and how you operate and how you may deal with issues down the road, was supervisory or not, changing your regulator is a significant aspect. So the other one is, the other part I want to talk about a little bit is the Consumer Protection Agency. And again, I'm not going to go into details on this. I'm just trying to give you a flavor of the drastic change that is out there and what, let's say, Hallock's forecast is where it's possibly going to go. Consumer Protection Agency is an independent agency of the government. It's rulemaking, enforcement authority, and supervision of all financial institutions. This is the Obama administration and the Dodd plan. Plain vanilla products. You've probably heard about this. And part of the Obama plan is that if you had a plain vanilla product, you're okay. The government's going to tell you what the product should be, the terms of the product. If you want something different, you then have to apply to this 5-person board, bureaucracy brought into it, obviously, and to get a different product. Is there any doubt in anybody's mind, if you wanted something different to enhance your customer base, to make you more competitive than the fellow down the street or the gal down the street, what that would be? The plain vanilla product, everybody's offering the same mortgage products. Everybody's offering the same savings products. Everybody's offering the same checking accounts. Maybe different rates, blah, blah, blah. But again, it's a plain vanilla product. You want something different, you got to apply to the government for that. If you wanted to advertise the different product, you're going to have to ask the government. I just don't see how you could ever meet any kind of deadline or any kind of advertising program by going through the government and the bureaucracy that we'd be facing with. So obviously, this plan coming down from the Obama administration, you'll see, has changed drastically when it got to the House. Where it lies in the Senate right now, I think, the Dodd bill. I'll get to it later on about where the Dodd bill is. The House did something fairly decent on this, but it's still going to be a little bit onerous. Rulemaking and examination still apply in the House. But what they did is on the examination side, they took those institutions that were less than $10 billion, and that may be, that number still may fluctuate higher when the final package is approved by the entire House. Primary regulator, if you're under $10 billion, which except for in New Jersey, except for domiciled banks, except for Hudson City and Valley, I would assume that means all the other banks are under $10 billion. The primary regulator would be responsible for the supervision of your consumer protection rules that are going to come out of the Consumer Protection Agency. Plain vanilla products are gone. Key words in this legislation that the Consumer Protection Agency will be responsible for is unfair, deceptive, and abusive practices. Now, I think both trade groups nationally, the ICBA and the ABA, have both probably taken a position maybe somewhat different on this, but both of them feel that the Consumer Protection Agency is well-meaning. There's good points to this. This will get at the mortgage bankers program that helped get us into this environment that we have. One of the interesting statistics, I don't know if you know this, that and it came out from the Treasury, 94% of the subprime loans that were originated nationwide that led to this crisis were originated outside the regulated banking industry. So the problem was not the regulated banking industry, it was the unregulated. This particular part of the legislation will certainly go a long way to helping that, but it also hinders us. Now, it looks like a decent change. You'll be able to deal with whoever your regulator was, except it was OTS, and be worried about consumer protection. The industry has been very concerned that if you have a different agency on consumer protection and the primary regulator is worried about safety and soundness, there's going to be a conflict. And quite frankly, there will be a conflict. The Consumer Protection Agency may be pushing you into loans that you don't want to do versus safety and soundness from your primary regulator. So this was a major help, except that if a customer has a complaint, the customer is not going to respond to the primary regulator, it's going to respond to the Consumer Protection Agency, who you're going to have to respond to. And the Consumer Protection Agency, if they feel your primary regulator is not supervising you correctly, has the power to come in and provide that supervision and do examinations of your consumer protection policies and procedures. So, nice news. Where do we stand and where are we going on this? This is my forecast on where we're going on some of this. I may disagree with both national trade groups, but I'm on the board of directors of the ABA, and quite frankly, the flux of change, constant, every week we have probably about 2 one-hour conference calls on what's going on this legislation. Jim Silkinson or John McQueenie usually jump in on some of those conversations too for New Jersey bankers. But it is an area that is fast changing, and hopefully in the next slide or the slide after that, I'll tell you how maybe you can be helpful in this regard. The Barney Frank factor. Barney Frank, for whatever reason, bankers in Massachusetts love Barney Frank. How can I say this without getting into trouble? They love him in a philosophical sense, okay? They don't love him in a physical sense, okay? Put it that way. Barney, his main goal has always been the Consumer Protection Agency. That's passed, that's sacrosanct as far as he's concerned. When this entire package goes to the floor, Barney doesn't want that changed. There may be some horse trading on some of the other factors that are going into some of the other parts, the restructuring that we talked about, who your supervisor is going to be, but that Barney Frank does not want to change. That's going to be a little bit of a conflict that I'll explain later on. Is Senator Dodd a player? Well, Senator Dodd had a choice of taking the Senate Banking Committee or the Health and Financial Services Committee. which would have been health care when Senator Kennedy got ill. He elected to stay on the Senate Banking Committee. Senator Dodd has problems in the state of Connecticut. He's behind significantly in the polls. He's been listed with the Friends of Angelo Mazzillo program and getting a sweetheart deal allegedly from Countrywide. And he's also had the situation with AIG and bonuses. So he's down in the polls. He's certainly bounced back a little bit from where he was. But come January 1, Senator Dodd doesn't not go into Iowa, but for a whole year, he's going to be concentrating on re-election because he is up in the fall, November of 2010. So is Dodd a player? His bill that he submitted of 1,100 pages was not well received, certainly by Republicans, who was not well received by certain leading Democrats on the committee. So his bill, as structured, was a little bit even more oppressive than the plan that came out from the Obama administration. I'll get to what the Republican strategy is, and that ties into Senator Dodd a little bit if he is a player. The final restructure. House bill versus Republicans as Dodd's friend. There's a number of people on the House Financial Services Committee, Republicans, who don't want the Consumer Protection Agency, but they also like the idea of one regulator, which is the Dodd plan that comes out, just one overall regulator. They haven't committed to that, but it certainly entices them. One of those leading Republicans on that committee is Congressman Garrett, who's in charge of a major subcommittee of the House Financial Services Committee. He's from the state of New Jersey. He's intrigued by the Dodd plan. He hasn't committed one way or the other, but he's certainly intrigued by that. That's something that's scary because if the Republicans line up on one regulator, that could be a four-flight fight. The restructuring plan of the House bill that passed the House Financial Services Committee yesterday only passed 31 to 28. Democrats have a significant majority in that committee. It only passed by 3 votes. So obviously when it gets to the House floor, that restructuring could be a problem, and where Republicans lie on this one regulator is certainly an issue up in the air. One of the things you're going to find, what I'm going to suggest at the end is making sure you stay in touch with your congressperson, is you're going to find that the person is not on the House Financial Services Committee. They don't know much about what's going on here. But what they do know, they don't like banks. We've done a good job of convincing them that Wall Street and Main Street banking are totally different. But still, that's an issue out there. The Federal Reserve factor. Part of the bill that got through, interesting enough, with Republican support, an amendment that got through, is the Ron Paul amendment with respect to the Federal Reserve. And what happened in that piece of legislation is, and it passed pretty overwhelmingly by Republicans and some Democrats shifting over, was the fact that the GOA was given the power to review, to audit, actually, the Federal Reserve. This is probably the first step, though it's not law yet, but the first concrete step of probably intrusion on the independence of the Federal Reserve in some time. As you probably know, Ron Paul is an individual that didn't run for president. He does not believe we should have the Federal Reserve at all. So there's a Federal Reserve factor here. Barney Frank is complete support of the Federal Reserve, complete support of giving more power to the Federal Reserve, and as a result, that factor and where it goes on the floor is going to be interesting to see. It's going to play out. The Republican strategy in all this, as told to me by a number of Republicans, their strategy is they do not want the Consumer Protection Agency, and their battle is to push it into the Senate and to take the Dodd bill down. That's their strategy. Democratic strategy is very easy on this. Give me some piece of legislation that'll indicate that we've had change. What other issues are out there, and I want to get back to what perhaps is most important, is what you can be involved in this process. Overdraft fees. As you probably know, the Federal Reserve came out and tried to beat back this legislation a little bit by coming out with some new guidelines on overdraft fees and opt-in on overdraft protection plans at the point of sale, ATM transactions as well as individual single debit card transactions. Dodd has come out with a bill. I don't know how many pages that is, but the Dodd bill is extremely oppressive. Would limit you to 6 overdraft fees in 1 year, 1 per month. A lot of opt-in provisions on that, opt-in provisions on everything, including ongoing direct debit transactions that you have on a monthly basis. Maloney's bill is even more oppressive than the Dodd bill, and Barney Frank's on board on this. There's some feeling that the Federal Reserve action may have reduced the risk to our industry. And what I mean by reduce the risk to our industry, trying to put some of these items into your systems is going to be very costly. The Federal Reserve is due by July 1. Also, I'm sure most of the financial institutions in this room consider overdraft fee a significant part of non-interest income. Reducing that to 6 a year on one customer will certainly have a major effect on your income stream. One final piece of legislation that we haven't heard out there, and the reason I raised this is because of the, let me say this positively, the dubious reputation of Senator Durbin, the senator from Illinois. Bankruptcy reform is one of the key points that he has. Will he try to attach that at some point? We just saw the administration come out and give a recap of where they stood on modification programs. I'm a conspiracy theorist, and certainly I think that that's probably laying some groundwork that someplace along this line in the process we got to worry about bankruptcy reform. We may have taken our eyes off it, both national groups may have taken our eyes off of it slightly because of other major items, but that can come up again. Let me go back on that bankruptcy reform and explain to you that sometimes bankers talking to legislators are more effective than the trade groups, even the state or ABA or ICBA. Several years ago, we introduced got bankruptcy reform passed in the U.S. Congress and the Senate. 2 of the key players in New Jersey who were Democrats, and the Democrats did not support bankruptcy reform, were Steve Rothman and now Senator Menendez, who at that time was a congressman from Hudson County, and he was the 3rd leading Democrat. Due to the persuasion of certainly the New Jersey bankers, the New Jersey League, and the New Jersey bankers, those legacy groups, there was an effective communication with Senator Menendez, or Congressman Menendez, that he broke with his party and supported bankruptcy reform. There was also a significant element of individual bank presidents getting involved in that process. Rothman also switched. I can tell you, Rothman is our congressman in Fair Lawn, and several trips to Washington with Rothman convinced him that people who make an obligation should pay it back and shouldn't get a free skate. So it does work. We've seen it in the past. Will Rothman and Menendez be in our corner on bankruptcy this time? No, won't be. But it tells you what can happen. There were the only 2 Democrats in the state of New Jersey that agreed with the action. This thing is fast moving. Started in July with the Obama plan. We're at it right now. The House has moved tremendously fast in this. The House does move tremendously fast on legislation. The Senate has not. You need to keep abreast of this and need to be actively involved in this process. You need to be involved in contacting legislators. This year we had, in March we went down to Washington and we had a record number of people. These legislators listen to you. They listen to the lobbyist that comes in, they look to the staff person, but they look to you when you come in because you're the person, you're the people that are putting jobs out there in their community. You're the person that's doing the community service in their community. You're the person that's most affected. They'll listen to John, and there's no insult to John, but they're going to listen probably more to me. Rothman's going to listen more to me because guess what? You're in my community and you're doing what? good in the community, you're putting jobs out there, you're providing mortgage loans, I am going to listen to you. That's why it's extremely important in this process, and it's not that bankers take an active part. Whether it's a letter campaign, whether it's calls to their office, it does work. It has worked. It just worked recently, and I'll explain to you where it worked in the legislation process on a key portion of an amendment that went through the House Financial Services Committee. Also, I would strike to you that we've done a pretty effective job probably telling Congress that we're Main Street banking, not Wall Street banking. They've gotten that message. They didn't have that message a year and a half ago, 2 years ago. They were throwing darts at every financial institution, including us. But it's still a job that has to be done. And the way that can be done is not only contacting the legislators, telling your story within your community. I know I'm preaching to the choir here, but it's also maybe the message going back to your CEOs that that's extremely important to spend the money to spell a job out that you're doing in the community. Because there's one bank in this country, Fifth Third in Ohio, that got that as a thrift institution and was worried about their thrift charter. They had their customers involved in the process and sending letters, resulting in a number of thousands of letters that went to the respective congressmen in Ohio that changed the picture around on this piece of legislation. So it does work. I would not suggest, we actually looked at that at our bank, and there's a mixed bag of getting your customers involved in it. First thing they're going to ask you is, oh, you have trouble? Are you going down? You know, that type of thing. So it's there's an area there you got to be very concerned about. But believe me, telling your story is extremely important. And getting the point across that you're Main Street banking, you are not involved in the process. 94% of these loans were originated outside the banking industry. You were not involved in the subprime loans. Guess what? This is extremely important to get that message across. Another message that doesn't probably register, and probably doesn't even register with the legislators, that's what's scary, is very few of them understand that the FDIC, no tax dollars goes to the FDIC. The consumer thinks that all this stuff that's going on with the FDIC, it's bailout money again coming from the government. There's only one time in the history of the FDIC they borrowed from the U.S. government and paid that back for a relatively short period of time. And that was part of the process that just went on with the special assessment, and the 3-year payment was, should the FDIC borrow from the government rather than taxing the industry? It was a tough decision to be made, tough decision probably made for both trade groups, but I'm fully concur that we should not use the line of credit at the Treasury to support the FDIC unless it's really, really necessary. The FDIC and not having taxpayer dollars go to it, we support the FDIC. The FDIC doesn't have any stockholders. But is there any doubt who provides the capital to the FDIC? One of the things that has been a thorn in my side, I'm trying to get the National Trade Group, the ABA, on board on this, is the FDIC, as far as I'm concerned, their resolution of problems is probably a quick fix, and it could be done in a more systematic way that would create less losses to the FDIC. Less losses mean less expense to you eventually down the road. We provide the money to the FDIC. We should have some oversight as a group, as a banking industry, as to how the FDIC is resolving those issues and problems. So those are some of the things that I would suggest to you that you get involved in. Again, contacting your legislator is extremely important. You can go through the New Jersey bankers, you can go through ICBA, you can go through ABA, or whatever trade group you belong to get that information. But contacting those legislators as this legislation moves through can work. Let me give you an example. The last example before I call it quits up here and entertain any questions is the recent process that went through the House Financial Services Committee. Part of the issue that we've just gone through with the economy and the subprime market has certainly been, in some people's minds, certainly in my mind, the FASB approach on what we call OTTI, or other than temporary impairment. It didn't cause the problem, but it certainly enabled the problem to spread a little further and a little bit more aggressively, that it caused some issues. Congressman Garrett certainly came forward in the spring of this year, and his committee looked at FASB and certainly put a little pressure on FASB to come out with new guidance that provided some relief to the financial industry and how they approach this issue. Congressman Perlmutter and Congressman Harris, a Democrat and a Republican, wanted, as part of this restructuring going on in the financial industry, that this new oversight committee that would look at the systemic risk, there was 9 people on this oversight committee, that the systemic risk would have power over FASB. That did not sit well with some Republicans, did not sit well actually with Congressman Garrett. He was concerned about it. There was a heavy push to get to Congressman Garrett, and I thought President of Lakeland, Frank Schara, and myself spent a lot of time talking to his staff. John McQueenie spent time talking to the staff down there. And we didn't get exactly what we wanted, but we got doggone close to it. That it's an amendment that was approved, and it was approved pretty handsomely, that this oversight committee will have power to enunciate where they think FASB has gone wrong. They won't have power to change FASB, but will certainly have power to give input. And the SEC, which now oversees FASB, sits on this oversight committee. So it got through. It's not a direct challenge to FASB, an indirect challenge, but it certainly will look forward down the road. And you say, why is that important? Well, I'm very concerned that, FASB may be moving on mark-to-market accounting on all our loans, and that could be disastrous and a significant swing in interest rate risk. Interest rates go up significantly, the value of your loans go down. That could cause more problems down the road for us. But that contact with Garrett convinced him. The ABA told me that Garrett was a key person because the Republicans on our committee were going to listen to him on this issue since he chaired the subcommittee. And he did come around and support that amendment, and that's a key victory for the banking industry. Now, that may not sound like a lot, but in this environment, we take whatever victories we can get. We don't have too many victories. We're in a defensive mode. And I hope we're better than the football giants inside the red zone on defense. I really do. But right now, that's where we lie with legislation in Washington. Heaven knows I'm not going to talk about Trenton, but that's where it lies in Washington. This is a key, to me, is the biggest risk we face in the industry as a whole right now, is the effect of Washington can do. That threat probably is going to exist for at least, in my mind, through the summer of this year. There'll be probably a change in the off-year elections that maybe balance it off a little bit, but that's exactly where we stand right now.
Has there been any discussion in this overall process so far of streamlining of the foreclosure process?
That would be a state issue, and John McQueenie probably can answer that better than I can. And I only know about the tax situation and the push for 18 months, but John may be able to answer that.
Well, the second part of that maybe is, and I guess this would be the federal part of the question, federal level. How does, and if so or if not, how does that relate to the foreclosure mitigation discussion that's a hot topic in Washington and at
the modification program? Yeah,
modification program, the Obama.
And that's exactly why I think Durbin's bankruptcy thing is not dead. That's Senator Durbin is that's his lifeline. He firmly believes in that. It's he thinks judges should be able to reduce your mortgage loan balance, your interest rate, and the terms on your loans, or even forgive them. So that is I can't answer the question where it's going, but to me, bankruptcy reform is a quiet issue right now, but I think it's lurking out there and it's going to come back to haunt us.
The state actually controls a lot of the foreclosure laws here, and the process has become totally unrealistic. It takes 2 to 3 years to foreclose on a property. We think that's harmful to the homeowner who eventually has to give up their home anyway. It's certainly harmful to the real estate market that the recovery can't start sooner, and it harms the banks. It's funny you brought this up because we have the opportunity with the Christie transition team that's looking at banking issues to share issues that we think are important that the new administration needs to look at, and that's at the top of the list. But find a way that we can accelerate the foreclosure process to everybody's benefit that would help the real estate market turn around sooner, help people restart their lives, perhaps renting. And I think, I don't want to speak for all of our member banks, but many of them have told us they'd actually be willing to pay a higher fee to get the foreclosure closed sooner because the cost of carrying the property, maintaining it, the legal fees is just very cumbersome.
Is there a conflict there, maybe unspoken, between the federal government and their modification priorities and the state government, ideally?
Well, once it is foreclosure, the state laws take over, but certainly the success of the federal programs to modify mortgages would prevent them from getting to that point.
That's my point, and it seems like a lot of the judges, from what we experience working for banks, seem to be self-appointed, at least in their own minds, agents of modification. You know, the longer you can drag it out, the more time the consumer may have to find a way out or force the bank to make concessions, etc.
Just the volume of work is a problem. The state workers, the public workers who handle the foreclosures and the paperwork, that's been delayed, even if we didn't have these issues with how the law works. So it's a big issue, and it's going to be one I think the governor's going to tackle.
I'm live. Okay, I have a question. If we go to plain vanilla products,
that's dead right now. I don't think that's going anyplace. Again, it's changed in the House Financial Services Committee. I don't think it's going to change on a House floor. No one's been in favor of that. Even Barney Frank's gotten off of that, thought it was a little bit, he supported the Obama plan, but he switched on it. It's in the Dodd bill. The Dodd bill, you have some leading Democrats, Carper in Delaware doesn't agree with the plan. So what Dodd has done has broken up the plan a little bit and put bipartisan groups together, and hopefully those bipartisan groups can come back with changes in the plan. From what I gather, plain vanilla is going to be out of there. That's not, but that's the drastic kind of thing that can happen. When I saw that, I'll be honest with you, I'm afraid, maybe not asking your question right, but I'm afraid when I saw that, I said, are we being viewed as a public utility? And then being heavily regulated on that, what you can offer, what rate you can offer, and then who you give loans to?
Well, that was the second part of my thinking, was taking all the banks and just lumping us into 1, 2, or 3, depending on region. Is that a thought that they have?
What was that again?
Are they trying, if we all have the same product and we're all offering the same thing, are they trying to limit the number of banks?
That's what came out, I'm trying to say, it came out of the Obama plan. It's dead right now. I don't think that's going anyplace. But that's the kind of drastic change thought that was there. And we have to be on guard that something like that doesn't pop up in the future. So, again, let me just close again. You have the power to make change in your financial institutions and be part of the process. If you sit back 6 months after legislation is passed, don't blame anybody but yourself. This is our industry. We work for it. We get a nice, generally speaking, nice pay rate of return. You got to fight for it right now. Thank you.
We hope you enjoyed this presentation from the New Jersey Bank Marketing Association. For more information, visit njbankmarketing.com. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. On the web at professionalpodcasts.com. This is Steve Lubetkin. Thank you for joining us, and we'll see you out there on the net. Take good care.